My name is Steve Gribben, and thank you for joining me in this Glassbox strategy session. Today I want to cover the three primary types of financing available to small cap companies and how to avoid the major landmines associated with each. As a public company, you will likely get hit up by countless attorneys and investment bankers offering the newest and latest financing structures that are quote unquote different from anything ever offered before. But in reality, all of these structures typically fit into one of three categories. 1, asset-based financing, 2, cash flow-based financing, and 3, liquidity-based financing. Those are the three most common types of financing. Now, there are often new and innovative products that come to market within these categories, but these three categories in general remain a constant. I'll begin by discussing asset-based financing. Asset-based financing involves using your assets as collateral for a loan. Either all of your assets generally or maybe just one of your assets specifically. This type of financing is great when you have cash flow to cover your debt service. It's not so great when you don't have cash flow. One of the biggest challenges for small cap companies that enter asset-based financing agreements is that they often have to tie up a bunch of different assets to obtain a single loan. This basically hog-ties the company and prevents them from finding other takeout investors in the future. In my time as an attorney, I've actually seen a couple of instances where an asset-based lender took a first lien across all the assets of an issuer's balance sheet, watched the issuer go into default, then refused to give the issuer any sort of flexibility to enter a workout or restructuring arrangement, and finally foreclosed on all of the assets of the issuer. Oh, and then a few months later, they took the corporate shell to boot. Asset-based lenders don't often sound as menacing as other lenders, but you always have to have your guard up. They can be sharks just like any other type of lender. In my experience, I found it most pragmatic to use asset-based financing for acquisitions, either borrowing against your existing assets to make an acquisition or borrowing against your target assets in an acquisition. This will result in your loan enhancing your cash flow position and likely boosting your share value as well. Now, the second way to finance a company is based on cash flow alone. Traditionally, we think of cash flow lenders as banks offering a line of credit or a term loan after reviewing a bunch of due diligence items to verify that you are in fact realizing a net profit at this very moment. But in the public market, cash flow lenders are often merchant cash advance lenders in disguise. These MCA lenders will lend you a percentage of your historical revenue, regardless of your profitability. And then they'll auto-debit your bank account over some defined period of time for both the repayment of principal and their profit. The cost of this capital may not seem that bad at first, but it's often quoted in some terms other than an interest rate. And you'll have to remember that you only have access to the full advance amount for a very short period of time, because your repayment of principal begins pretty much immediately, or at least, at very best, 1 month after that principal is funded to you. One of the most prudent ways to use this type of cash flow financing is to bridge a gap. If you're coming up short on a closing, it may be valuable to have something like this in place. But I would find it hard to recommend using any type of MCA cash flow lender to finance a larger project or a longer term plan. Okay, so this brings us to the third and final way to finance a small cap company: liquidity-based financing. Let's say you don't have assets, you don't have cash flow, and most institutional investors don't really believe in your business plan, but you've got a retail following that really likes your stock and you've got consistent daily trading volume. It may sound strange, but in this scenario, investors will likely be beating down your door to lend you money. And if they don't get paid back in a certain amount of time, let's say 6 to 12 months, they will want to be paid in stock. And the way they will want to receive that stock at a hefty discount to market can be detrimental. This type of financing may be necessary at times for you to make it out of a cash flow crunch, especially early on if you haven't raised enough equity, but it's nearly always detrimental. It will likely push your stock price lower, dilute your existing investor base, and make it harder to raise further capital in the future. Still, with all of that said, there are ways for small cap companies to prudently leverage liquidity in their stock to raise capital. They just have to take control rather than letting the financiers with whom they are engaging take control. To be specific, there are ways for nearly all microcap and small cap companies from those listed on the OTC Pink Market all the way up to NASDAQ, to raise capital by selling stock at the current trading price of their stock, without having to pay an investor a large spread for standing in the middle of the transaction. Liquidity-based financing can actually be one of the most powerful tools available to small-cap companies. If used prudently, it can accelerate growth as fast, if not faster, than all other types of financing. But if used imprudently, it can also very quickly bury a company in a hole so deep it will never see the light again. So again, in summary, there are 3 ways to finance a small-cap company: with asset-based financing, cash flow-based financing, and liquidity-based financing. If you'd like help structuring a capital formation plan that uses each of these 3 categories while steering clear of any deadly landmines that may be lurking beneath the surface, please reach out to us. I look forward to speaking with you and learning more about your business and your specific opportunities. Thank you.